Niels and John, thank you so much for joining me today. Would you mind briefly introducing yourselves?
Yeah, of course. I'm John Wheeler. I'm Managing Director for EFM. I'm an accountant, chartered accountant, qualified quite a long time ago. I've spent my career working in practice with the Big Four, bit of time in banking, restructuring, turnaround, and I decided I wanted to become a fractional FD and work with SMEs about 5 years ago. So joined EFM and now working as Managing Director for the network. And EFM is a network of self-employed fractional, aka part-time finance directors, CFOs. We're nationwide. We've got about 60 associate FDs and CFOs who work with us as part of our network. And we support SMEs across the country with their finance resource needs.
Thank you.
Thanks so much for having us. So I'm Nils, Lloyd-Penny. I've got two roles really. So I'm an operations director at EFM and have been for the sort of past 18 months or so. My background is I trained in finance transformation and finance consultancy type services at Accenture. And for the past sort of 8 or 9 years, I've been running a recruitment business. And within that, we work similar to EFM, predominantly in the SME sector, from a finance and accounting point of view. So we cover roles from bookkeeper all the way through to FD and CFO. And that is on a permanent basis, part-time, interim, fractional, you name it. We sort of cover all bases. So I've worked with EFM very closely for the past couple of years. And my role really is to sort of sit across the fractional FD recruitment. And we also provide more of a permanent finance recruitment service at EFM as well.
So we're all aware of kind of the pressure that business owners are under at the moment and the economy. So how are you seeing this translate in the context of finance recruitment?
Yeah, sure. So I think from my side, so I sit across permanent and part-time, interim and fractional type recruitment, which we'll come on to. But whenever there is uncertainty, as there has been pretty much across the last sort of, few years really, whenever there is uncertainty, permanent recruitment does tend to take a bit of a hit. In the last 12 months, we've certainly seen that. So I saw across sort of all the major jobs boards in the last 12 months, there's fewer permanent roles that have been advertised in finance in the last year than there has at any point in the last 10 years, which is a pretty, frightening statistic if you're looking for a permanent job. But what we are seeing is at any point where the permanent market does perhaps take a bit of a dip, we see an increase in demand for part-time resource. And increasingly in the finance world, what we're seeing is that can mean sort of a fractional resource, fractional FD, fractional CFO, or even an interim resource, which is brought in specifically perhaps to plug a specific gap. So yeah, there is a lot of uncertainty, but it's sort of, because I sit across the full spectrum, I suppose, of finance, it's sort of when the permanent market takes a bit of a hit, sort of part-time interim stuff goes up and vice versa. When things are a bit more certain, I think businesses in particular are less risk averse, and so they're happy to sort of take on that sort of chunkier permanent resource.
Okay, and John, from a fractional perspective, what have you been seeing?
There's definitely more of a buzz around and the use of the word fractional in the marketplace. And to me, fractional, to cut across the jargon, it really just means part-time. So we work with a network of FDs, CFOs, senior finance people who are generally all self-employed, who operate a portfolio of clients, and they do so on a fractional, i.e. part-time basis. The key to that is that it is truly flexible. So you can offer resource to clients from a few hours a week or a few hours a month even, up to a number of days per month. That can be on a retained type basis. It can be on a pay-as-you-go basis. And I think because of that flexibility that fractional type role offers, you're seeing an increase in demand for that and an increase in the marketplace in terms of the number of people who are offering those kind of services.
So, John, how can a business owner know that their finance setup is fit for purpose? Would you say there are any signs or indicators that they should be assessing that?
Yeah, I mean, I think in the world of SMEs, there is no one size fits all answer to what a perfect finance department should look like. And across the businesses that we work with, we see a real variety from almost no finance department at all. Generally, those businesses will be working with an external accountant, obviously, who'll be producing the statutory accounts that need to be filed with Companies House and the corporation tax returns. But then to businesses that maybe have bigger growth plans or are looking to do something transformational in the business, whether that is to grow fast, to raise equity, raise debt, so take on some sort of loan or cash flow financing or trade finance. Those businesses are inevitably going to need, at some point in that journey, a lot more financial information, and they're going to need that look forward rather than that looking back in terms of financial information. And that's probably where you're going to need quite specific senior strategic type finance support, and a fractional FD or CFO is generally the kind of perfect resource to provide that kind of advice and that information to a business. So I think it all depends on whether the business is stable and steady state, or is going to be doing something, growing or changing in some sort of way.
Great, okay. And Niels, is there then a difference between the needs of, say, a business with a turnover of 500k compared to like 5 million turnover?
Good question, and that's something that comes up a lot, is sort of the turnover figure. And back to John's point, it isn't a one size fits all. And I always think it's not, the best starting point is not looking at the turnover side. So for example, we've worked with clients who are 5 million turnover, an IT outsourcing business that only really have 2 clients. So, day to day from a finance point of view, there's not really a lot going on because they're on sort of a monthly retained invoice. There's not the need for that big finance function, which, you might need in a 5 million turnover business, which we've worked with, for instance, who do cleaning contracts, where it's high volume, they need really strong credit control type functions. There, they probably have more of a need for very sort of hands-on transactional day-to-day finance staff. And in that first instance, their requirement was, at some stage within the next 2 years, we want to exit this business. So we'll bring in a fractional FD to sort of help us through that period of due diligence, make sure we're set up correctly so that at the point we are acquired, everything is fine and set up as it should be. Whereas with the sort of high volume business, that was more a case of, we actually want a fractional FD to come in and really help us to shape. We've got loads and loads of customers, loads of invoices, lots going on, but at the end of the month, we have no idea if we're profitable. So that was to sort of set up the finance function from scratch, essentially, with a longer term plan of, let's say the fractional FD was there for 6 months, somewhere down an account assistant, a credit controller, that sort of more traditional type makeup. So, I don't think you should look at it as what's a 500k business or a 5 million business. I think it's assessing it all on a sort of case by case. What is the need of the business and what is their plan in the next 12, 24 months?
Just to come in with a couple of examples on that of recent cases that I've been involved with. Thinking about the turnover size can be a little bit misleading depending on where that business is in its journey, whatever that journey might look like. So I've recently worked with a 500k business in the financial services sector, grow by acquisition, and is acquiring a 4 million turnover business in the financial services sector. Now that 500k business, steady state, didn't really have a finance department. It just produced statutory accounts at year end. But in acquiring a much bigger business, in terms of what that's going to mean for the new business, the group post-acquisition, they're going to need a lot more support. They're going to have debt and equity investors involved. There's going to be a need to be a big provision of financial information, and they're going to need more finance resource to do that. You may have a steady state business, like a cleaning business, for example, that turns over 500k, has a number of staff, but it doesn't really need a huge amount. It's not changing in any way. So I think it really depends on the growth or the journey or the way that business is going to evolve or change over a period of time. I've worked with another client that is broadly that sort of 5 million turnover range that really, when I became involved, only had a self-taught office manager who was running the books, didn't produce any financial information, any management information. Now the owners of that business are now looking to exit, to sell, and to do that, they need a huge amount more information, financial forecasts, valuations, etc., and they've needed to bring finance resource in on a part-time fractional type pay-as-you-go basis to get them through that exit process.
Brilliant. So it depends on not revenue, but the situation. And
I think so.
I think so, yeah.
Absolutely.
So, John, where do you see business owners go wrong when it comes to finance hiring?
Yeah, I mean, I think there's a lot of potential pitfalls. And I'll come back to the point I made earlier about that kind of no one size fits all. And the way businesses grow organically and their finance resource then tends to grow organically as well is you may end up in a situation where you're aligning the wrong tasks with the wrong people, or people who it's maybe a stretch of their skills or experience to produce the kind of financial output that the business needs as it's changing and evolving and developing. And I guess a few examples of that we see and where things can go potentially a bit wrong is, most small businesses, when they start up, they're going to need an external accountant, what I would call a compliance accountant, and that's an external accountant who's going to produce their annual accounts and tax returns and company's house submissions. And then the business owner will tap into that resource and say, well, can you help me? I now need to produce a cash flow, or I need some management information, or I'm talking to a customer or supplier who needs certain information from me. Can you help? And usually that external accountant, of course, will say yes, and they'll try and pick that work up. And that may then grow, and you may find that those external accountants are producing your management accounts, whether it's quarterly or monthly. They might not be best placed to be doing that. They might do a very good job, but they might not be. And sometimes that, because they don't have those insights that somebody closer to the business is likely to have. You may also have situations, and we've alluded to it earlier, where you've got people who have grown or developed into a role, let's say an office manager who's doing bookkeeping, and that office manager who's also a bookkeeper then is starting to produce certain management information, management reports, but really that's probably slightly out of their comfort zone. And if the quality of the input isn't great, then the output potentially isn't going to be great as well. And I've mentioned a few times already, in terms of the business journey and where it wants to go, the pitfall can then be you just don't have the quality information that you need if you're going to be talking to a lender or somebody who's interested in potentially purchasing the business. You're really going to need to grow and improve the quality of that financial information and output. And so you're going to need to realign the resource and get the right resource and capacity in to be able to do that.
Yeah, absolutely. And I would just also add that from my side, looking across the recruitment, sort of, especially on the permanent sector side, quite often the mistakes that we see, it's around timing from SME businesses, but also not really having those realistic expectations. So something you will often find is, from a timing perspective, is most people at the point of hiring a permanent resource are doing so because they need to recruit to get themselves out of a problem. So typically most businesses are not that forward, they're not looking ahead 12, 24 months from a hiring point of view. So it might be that someone has resigned, or somebody's on long-term sick, or someone's going on maternity leave, and they're therefore being forced to recruit somebody into that role. So they're being quite reactive to that. And the traditional thought process would be, we'll put a job advert up, we will get applications and we'll get someone in. And that's where we see the problems in the sort of the hiring cycle. That's where they creep in, because you're quite quickly trying to find somebody for a particular role that needs to be fixed today. So you might take somebody on, who's immediately available and they can start next week, which could work out absolutely fine. But actually, what they're probably better off doing is looking at a solution where they can sort of maybe get somebody in place who can sort of hold the fort. And I know you've got examples of this where you sort of bridge that gap, and then you look forward to actually what is the right resource for this role long term. So let's look at the permanent recruitment as a long-term process and get it right. And in the shorter term, let's bring in an interim resource or a fractional resource. I think you've seen success of that, certainly at the FD level, haven't you, where you can sort of bring somebody in and they can bridge that gap to sort of get everything sorted quickly, but give you that time to do the hiring right.
Yeah, absolutely. I mean, we talk to clients on a regular basis where there's an immediate need for something, and timing's critical, and it's a really important point that you make, Niels, because there's often a burning pile, what I call a burning platform for something. Maybe a business is trying to raise some money, trying to refinance, and a bank saying, look, I need a 3-5 year integrated forecast to support the lend. And the business just doesn't have that financial information. How's it going to get it? They maybe have a gap in their resource, looking to hire a permanent FD or financial controller. But that could take 3, 6, even 9 months potentially to get the right person. You need to bridge that gap, and we often help them do that. The timing is also an important point, of course, because a bank, if you're talking to a bank or a lender who's saying, I need this information to support me going to my credit team to enable me to approve this loan that you've asked for, or this financing that you've asked for, I need the information, maybe not now, but in the next few weeks, not in a few months' time when you've hired somebody who's capable of doing that work.
Yeah, and I think the last point I'd pick up on that is, I think that also links into it's having realistic expectations of what you need now versus what you need in the next year, 2 years, and where the issues come in is where those things are not aligned. So SMEs are often, they've got budget constraints, they have got timing constraints, and there's a million things going on day to day in an SME business that need solving. But if you sort of panic recruit, that's where issues tend to come in, and actually getting that sort of stability quickly from a fractional resource can sort of give you that breathing room. And also from a budget point of view, it can give you the skills you need, I don't want to say for a fraction of the cost, but for a lesser cost than a full-time resource, which again, I think really helps to sort of give you that smoother process for, okay, over the next 12 months, we know what we want to solve, we can bring in a resource quickly to give us that sort of strategic skill set, and we can then actually put plans in place rather than being sort of fairly reactive to, let's just bring people in because they seem to be the right people.
So there's been a real rise in, I think, the term fractional and kind of the number of roles and the different offerings that we see out there. What would you say about, what you've seen over the last few years?
Yeah, absolutely. So, I mean, fractional seems to be the buzzword at the moment, doesn't it? It's exploded in the past couple of years. I think you only have to look on, I think LinkedIn put some stats out around, I think a couple of years ago, there was 2,000 profiles that roughly mentioned the word fractional, and now it's something like 100,000 plus last year. So there are a lot more people using the term fractional. I think there's a lot of misconceptions about it, which we'll cover. I think ultimately what we're seeing across my networks there are ultimately fewer permanent roles in the market, and a lot of people, I think, especially at the experienced end of the finance spectrum, so those people who are FCs, FDs, CFOs, they've got a lot of experience and insights that they can offer, and what they're now looking to do is essentially offer that to businesses on a part-time, more flexible model. So I think from my side, I view fractional in quite a simple way, which is you're essentially getting part-time support, part-time very experienced support. It can be strategic support. You're getting insights from professionals who are perhaps working across a portfolio of clients, and you're typically getting that on anything from a day or 2 days a month to a day, 2 days a week. Would you agree?
Yeah, absolutely. I mean, the beauty is the flexibility.
Yeah.
And also the potential for it to be a longer term type relationship. One of the misconceptions that I often hear around what does fractional mean and what am I going to get in my business from somebody who's fractional is that the business owner kind of thinks that it's going to be more of an interim style relationship, i.e. what I mean by interim is temporary. So somebody's going to come in, work with me for a period until something else happens, until I recruit somebody permanently, or I need a different type of resource. That can be the case, but often that isn't the case. And a lot of our clients actually end up working with our FDs, our CFOs over a long period of time. Some of our longest clients are over 10 years. And we've worked with those businesses over a long period of time with the same person as FD, CFO, generally speaking, in that business. And it's not like an outsourced role where that individual isn't present in the business, isn't part of the business. You know, anecdotally, you know, some of our longer term FDs, CFOs who are associates and only working part-time in those businesses, they go to Christmas parties, you know, they get involved with social stuff as well. They are part and parcel of the business. And that's really important, right? Because they need to be involved in the operations of the business to really understand the drivers, the levers, to understand how the finances work, and therefore where the business is going and how they can help shape that strategy. So I think the misconception is about the temporary nature of fractional, and it really isn't, or certainly doesn't have to be temporary, and it really can be genuinely flexible. I mean, I've worked with clients personally, and we see this quite regularly, from as little as a few hours a month. So maybe somebody, a founder of an early stage startup who isn't really au fait with finance and financial terms and jargon, and is looking to grow their business and maybe start talking to scary sounding people like venture capitalists and business angels who are going to be asking them lots of questions around KPIs and things that they don't fully understand. You can tap into somebody who really does have that knowledge and experience from as little as a few hours a month, and therefore that's very cost effective, through to the kind of resource, the still part-time, but the more sort of retained type resource where you're in the business 1, maybe 2 days a week. That can be remotely, that can be on site. It really can be a mix, and really up to the business owner in terms of what they want from that fractional worker and how they're going to add best value.
And that for me is also the key point around you're getting that long-term, or potentially very long-term support, who's someone who's as part of your team, but you're getting them to fit your budget. You know, you're not having to pay the sort of big price for a full-time FD or CFO, but you're getting that level of resource for, as you say, a couple of hours a month, a couple of hours a week. It can flex, and I think that's the really important part of it.
And it can flex up and down, right, as well. So if you take somebody on, and let's say it's for 2 days a month, and you need to increase that after a period, the beauty of the fractional model, where most of the people who are fulfilling that role work with a portfolio of clients, is all of their clients will be flexing.
Yeah.
So there is genuine flexibility within the model in terms of, you know, I'm going to need a couple of extra days from you next month. Generally speaking, in most cases, that should be eminently doable.
Yeah.
I think one of the things I've observed as well is the fact that the associates are going in and out of so many different businesses, is they've almost seen it all. They can bring insight from other businesses into what they're working on. And also they have that connection with 59 other FDs, so they can discuss and call on other people's expertise.
Yeah, absolutely. And actually what you're getting there is potentially someone who, it's good in my eyes to get that outside perspective, because you know we all know what it's like day to day. You're working within your business, you can get tunnel vision really of where you're going. I suppose with exactly that scenario where you've got someone who's perhaps working with 3 or 4 SME businesses, they don't even need to be in the same sector. That's the beauty of finance, really. At the end of the day, it's very sort of industry agnostic. Someone will come into your business, and it might be that you're going through a particular project challenge. You know, it could be a fundraise activity. Now they've probably done that with a client, you know, elsewhere, perhaps the month before, so they can give you that sort of insight that you wouldn't perhaps get from a full-time permanent resource, because they're working across that sort of breadth of different businesses.
Great. So if a business owner is watching this and kind of hearing everything that you've said, is there one or, you know, a few bits of advice you give them in terms of what should they be doing next?
Good question. One bit of advice I would give them. I think in any of these types of scenarios, I always revert back to, when I'm speaking to business owners, what is the ideal plan that you've got? So that could be, what's the plan for the next 12 months? It's not always as easy as that, we know, but I think as much as possible, if you can plan ahead, that's really going to help. From a recruitment point of view, recruitment can be timely, it can be costly. You know, if you're looking to hire a finance director, if you came today and said we want a full-time finance director, they might not actually be available for 6 to 9 months, because once you've gone through that life cycle of recruitment process, they've worked their notice period, you might not be getting them until sort of 9 months down the line. So as much as possible, I think, really plan, maybe think what are the 3 key priorities in the business over the next 12 months. And if there is a financial touch point to any of those, I think the key thing really is to speak to someone that is an expert or has expertise in those areas so that you can put a sensible plan in place as much as possible.
Yeah, just to add to that, I mean, I think that 12-month look forward is really important, but actually I'd also think about the medium to longer term strategy as well. So maybe 3 to 5 years, building on that sort of shorter term 12-month plan. What does a 3 to 5 year strategy look like for the business? And therefore, what are the gaps? What are the steps that the business is going to need to take, or the owners are going to need to take to reach those goals? And then try and backfill what's going to be required from a finance point of view to enable them to get there. So that could be a refinance, there could be a loan or a banking facility that's coming up for renewal. What does that look like? What information is going to be required? What steps are going to be needed to get through that process? An exit from the business, maybe an acquisition down the line, acquiring a competitor. Really thinking about those steps and those things that are likely to happen with those events within the business, and then aligning the resource up against that is the key recommendation really that I would give any owner. And just to add to that, either of us are absolutely happy to jump on any kind of one-to-one call for up to an hour with any owner, business owner, founder, director who's listening to this and wants to talk about finance, resource and strategy. We do that for all of our clients. It's free of charge. So please get in contact.
Brilliant. Thank you.